Welcome, everyone, and thank you for joining us today, as always. Um, I know that we've got some guests tonight. So, for anyone who doesn't know me, I'm Jeff Boccaccio. I'm one of the STA board members, and one of my responsibilities is organizing all these monthly events. For anybody that's not familiar with the Society of Technical Analysts, we are a non-profit organization. We focus on the promotion and education of all things technical analysis, of course, and that includes seasonals and cycles. Um, so that falls within the criteria, but it's not always like given the recognition it deserves, I don't think. And so more on that shortly. That's what we're going to talk about tonight. Now, the STA offers courses. Those are both live and self-paced courses, as well as exams where you can get a professional qualification in technical analysis if anyone is interested in pursuing that. But also, anybody can join as an associate member and take part in a bunch of different monthly events like this one, in our annual celebrations, and a few other things like our journals and that sort of thing too. So it's inexpensive to join, and you can kind of come along and join us for all of these things. So if you're not already a member, I'd encourage you to check it out. So now the eagle-eyed amongst you guys may be thinking that Dimitri's taken seasonality and cycles to the next level. He's found some sort of fountain of youth. But unfortunately, that's not quite the case. So Dimitri Speck, who was our intended speaker tonight, caught COVID just recently, I think over the weekend, and he's unable to present to us tonight, unfortunately. But maybe it's fortunate because we do have Giles Coghlan, who stepped in with to present to us tonight, quite last minute. So we're going to give Giles a hard time.
Yeah, thanks.
But no, so Giles, thank you so much for coming in. Giles is really familiar with SeasonX. He presents various webinars on behalf of them, and he's I'm going to say a power user himself, from what I understand. So he knows the product in and out, and he's going to talk to us about seasonals and then a little bit about the software. And what I'm going to do is hand it over to Giles now. And Giles, maybe you could introduce yourself a little bit as well to the audience. And
Yeah.
then he's going to give us a presentation for, I don't know, 45 minutes or so, and maybe talk us through some charts. And then we'll open it up to Q&A in the usual way. So if you could use the Q&A box at the bottom, it's a bit easier than the chat box. And then I'll come back on after Giles has finished presenting, and we'll do some Q&A and maybe throw up some charts if anybody has anything they want to look at. I think we can usually accommodate that. So without further ado, Giles, take it away.
Yeah, that's great, Jeff. It's very nice to be with you all this evening, and I'm really looking forward to showing you the insights that there are around seasonality. And I was just saying to Jeff before we got started on this presentation that seasonality is something that always gripped me as a trader. I started trading from mainly a technical perspective from about 2009. And over the years, I've sort of evolved to combine a deep sort of macro fundamental understanding. I've worked as an analyst for Forex Live, for brokers, and I'm often on sort of CNBC Arabia or Bloomberg about Ashrak, just explaining latest market moves from a fundamental perspective. But at heart, really, it's the technicals that have really gripped me, and that helped me to pursue a chartered market technician course to really sort of put some formal qualifications to that. And seasonality was something that always gripped me. I remember looking at the Bloomberg terminal and looking at the seasonal directions of the various instruments and just finding it absolutely fascinating. And that, of course, was before I came across SeasonX. And I am sorry for you that you haven't got Dimitri here this evening because he's a very humble man and a very great mind with his technical ability and especially his mathematical ability. And he sort of came up with the engine of SeasonX. And with Christoph and Taya together, they then created this incredibly simple, user-friendly product. So what I'm going to show you is I'm going to showcase some of the product this evening so you can just see how easy it is to use. And if you've ever looked at seasonality before, you'll suddenly be really, pleased at how easy and accessible SeasonX makes it. But I'm also going to share with you something very important, the principles underlying seasonals. Ultimately, it is a form of technical analysis, and we're going to look at some of the fundamental reasons that undergird the technicality of seasonals. So I hope you're going to find this interesting and informative. And we'll also have a time of Q&A, Stephanie, when we can take some questions and answers. And especially, there are some very good reasons why seasonality doesn't work. And there's some times when it's really turbocharged. And that's something what I, really like to do as well. And we'll have a look at some of those ETF sectors as well, Stephanie. I know that SeasonX has 25,000 different instruments that it showcases, and it's quite simple to look them up. So without further ado, let's get going. I have got the chat and Q&A box open in front of me. Now, there's one problem that I've noticed with this presentation, slight technical issue, is that when I'm clicking on the next slide, it tends to close the slideshow. So if that happens a couple of times, I will just adapt the screen so we can see the majority of the slideshow, but it won't be in this presentation mode. So if that happens, I'll let you know. Otherwise, let's get going. Yeah, we can have a look at silver and gold. Absolutely. Let's get going. So, so far so good. So, why do seasonal patterns occur? Now, there are so many different seasonal patterns in different markets. We see them in the major indices. We see them particularly if you look at this time now for like the S&P 500, the DAX, the FTSE 100, the Dow, all of those major indices experience a decent seasonal uptrend from this time, sort of October the 31st, through to year end, and even beyond through to April. You have so many different seasonal patterns in stocks. Some of them are sort of quite obvious around major earnings releases. You get seasonal patterns in currencies that are very pronounced. There's one that I like to go to at the end of each year, which is the dollar, which I'll show you a very interesting seasonal pattern for the dollar. We also get a big one in the yen. Commodities, of course, are in demand at certain times of the year. So that's why commodities tend to rise and fall on a seasonal basis. Bond market also has a seasonal pattern. Obviously, you get seasonality in home prices and generally economic data. And some of these seasonal patterns can happen yearly. Some of them happen intra-month. So there's certain times of the month when you'll get certain instruments enjoying a seasonal lift or a seasonal pressure. Intra-week, intraday, which is really quite fascinating. I've been really enjoying the E-mini, and Dimitri has some really good information on the E-mini, times when you're more likely to find buyers and sellers, as well as recurring events that happen each year. And those recurring events result in seasonal patterns. So seasonality is not limited to one place. Seasonality is spread across hundreds, thousands of different instruments, and pretty much, every financial market will have a seasonal pattern to note. And what the SeasonX chart shows you, and it takes a little bit of time just to make sure you understand this, but it's not very long. It's a very simple presentation of the seasonality. If you look at the horizontal axis, that is the time period. And the vertical axis is the percent move of the instrument. So if you look at this on the S&P 500, for instance, what you can see is on the left-hand side of the screen, you can see that up arrow, and you can see from January through to April, you see that green arrow pointing up, you can see that the S&P 500 tends to gain at that time of year. Then if you look at the middle section of the chart from May through to October, you can see that the pattern is much more sideways. And then from October through to the end of the year, we see once again have this very strong buy bias. So what the seasonal chart does is it breaks down that information into a specific and understandable figure. So what that tells you about the S&P 500, that from the end of October or end of September really through to April, the S&P 500 tends to experience seasonal gains, and then the summer is the flat period. And of course, you might have heard the Wall Street saying, sell in May and go away. In other words, investors expect May to be a generally poor time for the US stock market. And that seasonality plays out in the S&P 500. We'll look at it in some more detail. We're just sort of getting going with the principle of seasonality. So why is that the case? Well, the most likely reason is that it matches fund flows into equity markets. That funds tend to flow into major indices around those times of the year. From September through to April tends to be the largest period, the largest block of fund flows. And as those funds are flowing into the major indices, of course, they're more likely to lift higher. Now, not only is that strong seasonal pattern in the S&P 500, it's also very true in the FTSE 100 here in the UK. And if you look at the green line, that is the return of the FTSE 100 between November and April. And you notice how the return between November and April is superior to the entire all-year return of the FTSE. And then if you look at the red line, the summer line along the bottom, you can see that the gain in the summer is negligible. And that's from 1984 to 2016. So in other words, if you'd bought the FTSE every year in November and then sold at the end of April, your return, and you've done that for sort of since 1984 to 2016, your return would have been better than if you'd held the funds all the time. So it's actually a superior return, just highlighting that winter period. And it's not only the FTSE where you see that strong seasonal pattern, you also see it across a lot of major indices. And if you look at these major world indices here, notice the DAX, very strong winter period. UK FTSE, you can see here if you look in the winter column, that is the return for holding those major indices. You can see the index on the left-hand side next to the country. And then the winter return is that November to April period, which I've highlighted. And this is from 1970s and 80s to the year 2020. And if you look at those returns, you can see the average return for all of those indices is 7.6% return over that winter period, as opposed to the summer period where you can see the return is virtually flat. So the seasonal footprint in the major indices is very noticeable across all the major world indices and really does stand out and is significant. Now, you might think, well, okay, that's all well and good, but the major indices, it's a slower pace potentially of investing, and unless I'm trading the futures market, and even if I was trading the futures market, I'm sort of in and out intraday. I trade a lot of the E-mini, and you're thinking, well, is that really very useful for me? Well, perhaps it's useful if you were looking at buying your funds. When would you convert your cash and start buying your indexes? Well, it would make sense to buy them from a seasonal perspective at the end of October, early October, and go into cash in May, maybe put them into a money market fund and try and get some interest over the summer. You'd actually have a superior return just by using seasonality to do that. But These seasonal trends occur in so many different places that there is a significant opportunities elsewhere. And you get many individual stocks that show different seasonality, and it's very interesting. There are certain stocks when you see they have like nearly 100% return at certain times of the year. You see very strong seasonal patterns, and these individual stocks offer individual trading opportunities, and it becomes a lot easier for traders to take the benefit of than necessarily if you're investing. Um, if you also look, for instance, at Microsoft, they have a very strong end of year from sort of mid-October through to early November. They tend to surprise with their earnings, and you can see over the last 20 years, you get a very nice return. In fact, I'll just demonstrate to you how easy it is to use SeasonX. And I'll just quickly show you, Microsoft, and we'll have a quick look here, and we'll look over the last, 25 years. And you can see, here's that seasonal pattern that I just highlighted on the presentation. 76% winning trade percentage with an average return of 7.64%. That's how quick SeasonX is. That's how easy it is to find these patterns when you're displaying and wanting to quickly check out a instrument. And maybe there's something in the news. I'm often always looking at, there's some earnings coming up. I'm always having a quick look to see what the seasonal outlook is for an instrument, and it can offer some great opportunities. Sometimes even a miss in the earnings gives you a great opportunity to buy an instrument that's heading into a strong seasonal pattern. That's a great application for it. So why do seasonal patterns work? And there's so many different reasons why they work. Sometimes it's just simply due to the weather. For instance, there's certain times of the year when people are more likely to drive. There's greater demand for oil at certain times of the year, either for heating or for traveling. Similarly, harvesting. Often you see seasonal trends in commodities like soybeans, wheat, corn, because harvest periods tend to fall at the same time each year, and you tend to see price moves around those harvest periods. Of course, it does make sense, doesn't it? That certain commodities will be in more demand at certain times of the year. Of course, that's only common sense. And that also impacts the price of the underlying instrument. So the demand for commodities is influencing the price, and that leads to the seasonality, because certain people will want certain commodities at certain times of the year over and over again. Sometimes you see window dressing before reports. Earnings dynamics come into play, and you often see, if a company's been doing very well, maybe they have a certain reporting style. They tend to sort of under-promise and over-deliver, and that can result in outsized earnings reports that you can spot on the seasonal charts over and over again. Sometimes it can be as simple as taxes. For instance, in the US, there is an accounting phenomena at the end of the year that means it is more advantageous to send dollars to daughter companies around the world for year-end tax returns, and then bring those dollars back from daughter companies to parent companies in the US after the year's end. So I'll show you, you see this dip in the dollar and pick up in the dollar all around the end of the year. And that's just simply a taxation reason. There is a significant accounting benefit for dollars moving out to the US, as we approach the year end, and then back into the US once we've filed all our accounts. Decision-making periods, sometimes it can be a certain time of the year that you just have certain decisions being made that impacts the seasonal pattern. Earning surprise, sometimes it's just money flows. That each month, for instance, certain money will leave certain accounts and they'll find certain destinations every month at the same time. I'll show you a seasonal pattern in the stock market. that revolves around money leaving accounts, moving into equity funds around the turn of the month. It's a so-called turn of the month effect. And that can have a really marked difference in and a really marked impact in major indices. So here's the dollar index. You notice that in December, when large US companies move money to daughter companies to save taxes, you see the dollar drop. And then in January, the dollar rises as the money comes back into the US. I'll just show you that on the app so you can see how easy that is to use. You can just see, just looking at the dollar index, if you look over the last 25 years, you can see, look, last few days of the year, notice how the dollar tends to fall almost all the time. See, from the 21st of December to the 1st of January, there's a 76% losing trade percentage. So the dollar loses value 76% of the time for an average move of 0.70%. And then you get to the start of the year from the 1st through to the 8th, and you see the average return is 0.4%. So what the right hand took away, the left hand gives back at the start of the year. And that's just due to accounting reasons. And that flow in the dollar has, a tremendous impact. And of course, if you're trading the dollar index, the euro dollar is just the anti-dollar index, isn't it? So if you look at the euro US dollar, you see exactly the opposite trend, right? That you can take advantage of, exactly the same. So, if you're a currency trader, for instance, look at that. 80% bias to the upside in the euro dollar to end the year. Of course, and that's also benefited by the strong Santa rally, where you see the S&P 500 rise. I mean, euro dollar, S&P 500 moving high at the end of the year is just a very repeated pattern. Similarly, to start the year, euro dollar falling in line with that seasonal dynamic. You can see average return tends to be weak. So end of the year, average return 1.25% over the last 25 years. Start of the year, average return 0.82%. A very kind of repeatable and reliable seasonal pattern. Now, yes, the presidential cycle is very noticeable, Tris. And you do see significant moves in equity markets around US presidency, midterm elections, and you can find all that on SeasonX. It has a special section just for those elections. Gold has two periods of the year when it has a lot of demand. It's around sort of July and August. There's the Indian wedding season, and in the Far East, gold is tending to be gifted as a wedding gift. In the Far East, gold is quite different to how it is here in the West. In the West, gold is often sort of decorative. It's often just for jewelry. But in the Far East, gold is also a store of value, and it's a way of sort of showing your love to your family. You give them a gift of gold because it's, especially if your country has a very unstable currency, gold holds its value, and the gold in the Far East tends to be of a higher purity. And that sort of traditional wedding gift is given in India around the end of July, August time. And of course, gold prices go up. Similarly, in China, the Lunar New Year, again, a very traditional time to give gold gifts. And again, you see gold lift up in gold around the turn of the year. And you can see here from the 24th of December to the 26th of February, you can see gold prices gained 80% of the time with an average return of 4.11%. Right? That's tremendous information to have as you come to the end of the year. Now, if you can imagine, someone like myself with a strong macro background, if I coming to the end of the year and I'm thinking, okay, the Fed's going to be start cutting rates more aggressively than the market's thinking. I'm expecting the dollar to fall, and then I'm expecting yields to fall. Well, that's rocket fuel for gold. So if I start to put a macro picture together with that seasonal trend, then I'm thinking, great, I can't wait to buy gold. I'm just looking for any opportunity to buy gold around that period because I'm so yeah, grounded by these seasons. I know there's huge demand out there for the commodity for very good reasons because it's just literally as simple as a wedding gift. And if you look, let me just show you here. So let's just quickly look at gold here. Look at the last 25 years, right? You'll see from end of July into August, right? 80% winning trade percentage, average return of 2.62% around that August to beginning of September period. Okay. Similarly, end of December through to early Feb. You just see here, very simply, December, you can just plug in your dates like this manually if you want, which is a bit easier when it's you're putting it in across the end of the chart. Let's just put it in like 24th. You can see here that last 25 years, 72% winning trade percentage, average return 4.67%. Very quick and easy to deliver that. And that seasonal pattern is there for a very, very good reason. Another example is the so-called turn of the month effect. I alluded to this earlier, and this is the phenomena where stock markets tend to see significant gains around sort of the 26th to the 5th of the month, sort of the turn of the month. And the reason for this, of course, is to do with when are people paid? They're paid at the end of the month for the most part. And what do people often have coming out of their bank accounts around the end of the month? Their pension payments. And those pension payments end up going into pension funds. And when do pension funds end up scaling into their indexes? Around the turn of the month. So you have this bias to buy equities around the turn of the month because just practically speaking, that's when the cash is in the account. And as a result of that, very interestingly, you see this bias towards gains around the turn of the month. And the bias is very, very marked. If you look here on the S&P 500, look at the return for the S&P 500 around the turn of the month in the blue line, as opposed to the return with the investing in the S&P 500 for the rest of the month. Do you see? It's outsized. The benefit for investing around the turn of the month, it's almost better to invest for just that period of time because that's how strong that bias actually is. Looking in the UK, you see exactly the same. That investing in the FTSE 100 around the turn of the month is far superior to investing in the FTSE 100 over the rest of the month because of this turn of the month effect and the inflows that you see. The DAX, again, German efficiency, really highlighted here that the blue line, investing at the turn of the month, sees significant upside that you don't see around the rest of the month. And why? Of course, monthly cash flows. It's salary payments. So as you can see, when you stop and think about it, seasonality is actually intuitive because you think, well, of course, I buy an umbrella when it's raining, right? I buy a coat in the winter. I'll buy fireworks around, November the 5th here in the UK or around New Year's Eve. So just as our everyday to-day life has a seasonality to it, in exactly the same way, seasonality is really just a reflection of our human behavior and those needs and requirements are different from time to time. And of course, they form predictable patterns. There's also some seasonal patterns that you see intraday. Here you see the German DAX, and this is the chart course of the movement of the DAX over the last 50 trading days. And look what you tend to see. At the open, the DAX drops, and then it tends to rise after the initial drop. So that can tell you, if you were thinking, I need for my, equity firm, my fund, I need to buy a certain clip of the DAX every single day, you might think, well, I won't do it at the open. I'll wait 2 hours after the open. And it could be a very simple change like that, which could really have a significant impact on your bottom line, especially when you're using and trading in volume. So it'd be very interesting. And also, if you're trading the DAX intraday, maybe you're trading the DAX futures. A lot of people like to trade that. You can see, okay, you could look for early selling in that first hour of the day, and you just know that you've got that seasonal bias backing you. It just may help you hold just a little bit longer. Euro dollar intraday. This is the average course of the euro dollar over the last 170 trading days. And look, you see that around the US Open, you get an intermediate low. Okay, so this is US hours down at the bottom. So you can see as the US opens, it rises after that initial low. So euro dollar buying around 9:30, that's 2:30 UK time, bias for upside. Very, very helpful. Now, there are many events that influence markets. Central bank actions, elections. Of course, we've got the German election coming up here. And, this is how, Europe just called a snap. This is something I was looking at today. Snap election coming up for Europe after that surprise sacking of the finance minister. Election's going to be called for February. And if you just look at the event feature, you can see here, and you can look up your elections. And here is the German election. And if you look over the last 24 years, you can see that the bias, right, for the euro dollar through a German election, it's lost value every single time there's been a German election. Germany, obviously the powerhouse of Europe. And every year it's lost value in the day before to the 4 days after the euro dollar falls. And you can see here, the day into it, it's fallen 80% of the time. And, with all that dollar strength around it, I was looking at that, I was thinking, well, that's just the fact the election's been called is likely to weigh on the euro dollar today, for instance. And of course, we did see some, euro dollar selling in an early trade, which of course, makes a lot of sense. Reports. I like to use holidays again, the so-called Santa rally, just general optimism around the end of the year. Tend to see everyone just buying the S&P 500, just loving it. Very strong market around the turn of the year. Yeah, there is a light setting, Stephanie. Exactly. I totally understand it. It's the darker look helps those who are staring at it for hours and hours, but the lighter is better, isn't it? I agree with you, Stephanie. I prefer the lighter, but I use the darker just to keep my eyes. Now, very good thing about and a number of things that this is what Dim has been adding, is a number of these reports. And I'll show you how I use these reports. And I do a lot of macro trading where I'm looking at macro events, and I help clients understand which events are really going to move the market. So, for instance, tomorrow we got the CPI print coming out from the US, and I won't go into the macro picture, but if we see an out of consensus print there above market's maximum expectations, we're likely to see some significant downside in the euro dollar. Okay, if it comes in hotter than maximum expectations, I'll be looking for euro dollar downside. So I just quickly can come here and I can think, well, what could I reasonably expect? And I was speaking to Jeff about this at the start. What could I reasonably expect in terms of a move? And I just quickly look at reports, US, here we go. We've got the CPI print, just choose the CPI. And I can see, and what I'm looking at here is what is the expected move in the euro dollar. So for the 1 day, what I can see here, the average is 50-50 what the euro dollar does. But what I can see and what's helpful is when the euro dollar does fall, notice that it tends to fall about 1%, right? So then I can see what's the maximum drop. And you get to see, okay, the maximum drop here, 1.23, 1.44, 1.32, 1.37, 1.12. They're the maximum amounts that it falls. Now, if I got a really hot print in the CPI data, I know from my macro background, right, that will move the euro dollar a lot. And what the event feature helps me to see in this instance is what's the maximum I can expect? Well, actually, I could expect about 1 to 1.2%, right? So then I can go and place on my euro dollar chart a move of 1.2%. Does that line up with support resistance? Does that line up with other major technical areas that might be targeting? And so, for instance, if there's a big technical support area, sitting 1.2% away from price, I'm like, aha, I found my obvious take profit area. And that's because of Seasonax, the event feature, looking at all the CPI releases over the last 24 years. I can see the maximum move to the upside, the maximum move to the downside, and I can make an informed decision. Right. And these seasonalities tend to repeat themselves more often than not, many times, because for obvious reasons, you've got the same pressures. Now, this is the move for WTI futures with the 10 days before and after the last futures day of trading in the current contract for futures oil WTI. And notice that like in the 2 days before the contract closes, oil prices tends to fall. And then the new contract, the oil prices tends to rise. So you've got this down up bias, tremendously helpful. But if you're trading crude oil futures, very helpful information to have. If you're trading intraday, you're coming into the last day of the contract, you're looking to sell, right? First, you're through the first few days, you're having a bias for upside. Very helpful. The only thing is some years the seasonality doesn't work. So it's not like a magic formula or a holy grail, like a money-making machine in that you can't lose. Even very strong seasonal patterns, they don't work every year. So, look at the S&P 500 here, right? And then you look at the end of the year, right? Let's look at the end of the year of the last 25 years. Right, we're coming to the Santa rally. Here we are. 80% winning trade percentage, nearly a 1% return. That's a decent return in the E-mini. And look, sometimes you have 4.34% profit. Fantastic, right? But it didn't work in 2002, 2006, 2012, 2014, 2016. Now, sometimes there are other forces that are at work, right? Maybe the Fed its expectations are for higher interest rates that took the market by surprise. That's going to weigh on stocks. Maybe there's some other dominant macro fundamental narrative that's in the background. Okay, that's going to weigh on the seasonal pattern. So even strong seasonal patterns, like the Santa rally, it works in the last 71 years. It's worked 54 times between December the 14th and January the 4th, but 17 times it hasn't worked out. So Um, yeah, yeah, Stephanie, I understand. I feel exactly the same. I've started to have to, put my glasses on for looking things at small print, unfortunately. Um, so a few little tips for you. Um, Looking at the seasonal patterns, notice that they can change, right? So just pay attention to the current validity. So in this instance, say for the Dow, you can see like from 2011 to 2021, it suddenly had a stronger bias seasonally. Okay, you can see that seasonal dynamic has changed. So the seasonals can alter as market behavior alters and changes as well. So that's something to keep in mind, and just pay attention to the current validity. Look at the last sort of, more recent years. Has there been a shift that's changed things? That's obvious maybe like with a new instrument, something like Bitcoin, for instance. But it can also work out with other instruments as well. So that's something you want to look at. Has there been a change in dynamic? What's been happening most recently? Is it still valid? Worth looking at. Also, you want to see an even distribution. Now, the difference between these two stocks, do you see how they both seem to have a strong seasonal pattern? Look at Infineon and look at Align Technology and look at the highlighted rectangle on both. Well, at first sight, they both look like have really good strong seasonals, don't they? But they don't. And if you look at the box underneath the two charts, look at the align technology. Do you see how the pattern returns is evenly distributed across the years? That's a good pattern because it's pretty consistent in the way that it comes. Look at Infineon. Do you see how it's just this one large green return that happened in 2009? You see, that's not a good seasonal pattern. So it's obviously highlighting that that's a good time of the year, but it was one event which skewed the whole pattern. So you want to look for an even distribution that helps you find a better option. Now, there are so many different ways you can use seasonality. So you can trade the patterns directly, right? You can just take the seasonal pattern, buy and sell. It's fine. Um, and the seasonality does work out. But the problem is that what a lot of people struggle with is the drawdown that will involve. Because you're an instrument, it's 20% down. Oh, that can feel, too much. Especially if you've got one pot of money and you're trading it from stock to stock to stock, 20% drops is unpalatable for many people. But you can trade the seasonal patterns directly, and the back testing is very strong for seasonality. Other times you can use it for timing. Say you're wanting to buy into the major indexes. Well, buying at the major indexes at the end of October, from Halloween, 31st of October is a great time to buy in the indices until the start of May. You can also use it for filtering, right? You're looking at certain seasonal patterns to filter stocks in or out of a portfolio. You can also use seasonality as an additional input. In other words, you might be like a macro guy, um, uh, and say, for instance, take for instance, you're thinking, well, hang on, we just had the US election. President Trump is saying that he's going to make Bitcoin regulation easier. The Biden administration's on their way out. So the stricter um, regulation about Bitcoin is about to move into the background. So what does Bitcoin seasonals look like? And you might look at it and you just suddenly pour it up and say, well, hang on. Oh, look at this. Look at this. From where are we now? We're early November, right? So you might think, okay, from end of October, right, into the end of the year, it's a 64% winning trade percentage in Bitcoin, right? Or you maybe think, okay, mid-November to the end of the year, gee, it's quite an even distribution. 60% gains, 110% gains, 70% gains, annualized return nearly 200%, average return of 15.33%. over the last 14 years of Bitcoin from this period through to the end of the year. Right? You might use that as a way of just sort of filtering out different opportunities. You might use it at entry assistance for the maximum drop. Now, this is one thing I like using SeasonX for this. Let's say you wanted to buy, let's say you were thinking, you know what, I like this Bitcoin dip. I want to buy the dip. And you might look at it here and say, well, look at the maximum drop. And here you can see that the maximum drop over these last 14 years, like this is quite a large number, 48.98%. You might think, well, okay, well, let's say that's an outlier. What's the other general maximum drop? Look, it's about 30%. So you might look at that and say, well, actually, if I got a fall of about 20%, I'd like to dip by that. And realistically, I might have my stop at 30% fall. So you might think, well, I'll buy in at a 20% drop and have my stop at 30% because it only went to that far, only went over 48% once in 2018. And then you start putting that together with other technical analysis. You think, okay, well, I can manage my risk using the maximum drop. What's the sort of dip that I would want to buy? Okay. And I like using that maximum drop because it helps me. So you're like, okay, the pattern's positive, but what's the maximum drop? Of course, some years it doesn't drop at all, right? So it's not a foolproof method, but it can help with using seasonality. You can use it with your existing decision factors. Quite easy to implement. That's the beauty of SeasonX. As you've seen during this presentation, I've just been using it seamlessly, quickly, just highlighting seasonal patterns. I'll show you the app in a little bit more detail. But you can see here, Novo Nordisk, look at that in February, has a very strong upside bias. That's the manufacturer of that sort of wonder weight loss drug, Wegovy, Ozempic. There you can see, has very good seasonals at the start of the year. Adidas, everyone wants to get fit at the start of the year, don't they? Work off those Christmas pounds and off they go working out, buy their Adidas. Great German manufacturer of sports gear, the famous three stripes, look, has very strong seasonals from March to the end of April. It's a great stock, tends to have really good upside. And you can see some more details of this on the SeasonX website. But a long-term academic study found that seasonality over the last 200 years across 4 asset classes and 68 markets, seasonality beat value investing, momentum trading, carry trading, and trend trading. Seasonality exceeded them all. There was nearly 12% excess returns. There's the name of the academic study. You can look it up. You can find it. There is some links on the website. You can also take a screenshot of that and look at the recording and look up that academic study. Fascinating strength of seasonality. There is, folks, for those interested, if you wanted to sign up to SeasonX, I'll come to this at the end again, but there is a voucher, STA 20, to give you a one-time 20% off, and you get full access to 25,000 different instruments. Dimmy and the guys just want me to give you that code in case you wanted to sign up. If you just use this STA 20, it's with our partnership with STA that SeasonX are really happy to offer that one-time 20% off discount to give you full access. Jeff will have that code if you want it later. Otherwise, let me just go quickly into the SeasonX app and I'll just quickly show you. The beauty of it is you can just look up any instrument you want. So let's look up one of those instruments that you wanted to look at, XLK. And let's just see if we can find that. You can just go up to that and you can just search it up and you can see there's a technology select sector ETF XLK. If you look at that, Stephanie, you can see here over the last 25 years, you can detrend and you can see, okay, that technology stock sector ETF, super strong period from October the 11th to December the 9th. And you can see here the gained 75% winning trade percentage and 4.76% average return. Very, very strong. Super pattern. Now, excuse me, just a little bit of indigestion there. Right. That's how easy it is to use. Right. Let's look at XLB. There we go. Materials, again, look, even stronger ETF. And the nice thing about CZ as well, say you're thinking, oh, hang on, I don't want to look at 2008 because I know that was the global financial crisis, and that, I know why the ETF lost nearly 20%. I want to exclude that. So all you do is you go to all the years to display. I think I want to take out 2008. Then you can take out 2008 and now look at the return. It's nearly 6.62% average return, right? And a 91% winning trade percentage, just taking out that 2008 one. Yeah. Jason, I know you wanted to look at silver. All right. And you can see with silver, last 25 years, you see, look, it mirrors gold and that end of year pattern as well. You can see here, very nice seasonal pattern here. Mm. 72% winning trade percentage, 5.80% return, 24th of 7th to 19th of Feb. Yeah, David, if you want to look at the silver gold price ratio, and when you see the gold price ratio go to about 100, then that's just like an automatically buy silver. Okay, so look at that, David. Yeah. Okay. So the main things you can search all the instruments there. You can also screen for various. This is a fantastic feature here. So let's say the S&P 500, right? Let's say you want to find a stock that looks promising. You can look here at the stocks, right? Last 20 years. So you want to hold it between 31, 60 days, and you want to filter it with the maximum number of winners. You can see here, look, Deere and Company, 19 winners out of 20. Right? From 19th of November through to 31st of December, only lost value once, and that's 2021. Look at that. What a fantastic seasonal pattern. See, pretty even distribution. Average return 8.09%. And that just was 2 clicks of a button. Do you see how easy it is to use? And let's say you want to look, okay, well, I want to look at the NASDAQ. I'm into tech stocks right now. Okay, Monster Beverage. Look at that. They just had some disappointing earnings, didn't they? So that could be a great dip to buy. Look at that. Average return 8.19%, median return 8.11%, 90 winning trade percentage from now through to the end of the year. Right, fantastic. A great seasonal. And you can literally search, and then you wanted to search currency. You can see here, okay, Swiss franc. The Swiss tends to gain against the dollar, right? So, you can just look at the other. If you want to look at the other way around, according to the pairing, then you can see dollar Swiss franc tends to fall into year end, like 75% of the time. That's against the current bias to buy the dollar, isn't it? But you still get the point. Say you want to look at a sector of the S&P 500, thinking, okay, well, I really want to be looking at financials right now. See, okay, look, the Bank of New York Mellon. Fantastic upside, 90% winning trade percentage. Stephanie, so are there asset classes or companies that have stronger correlations to their respective seasonal trends? Yes, there are some like asset classes that perform better than others. And exactly why that is, I'm not sure. But you can understand with like US stocks, for instance, if you look at the US stock market, it's the world's leading economy. It's found, buyers for the last sort of 30, 40, 50 years plus. So it kind of makes sense that it's gaining, okay, over time as well. Um, and you could also filter with lots of other things. You could filter by the maximum profit. What's the maximum gain that there's been? Okay, look, what's the maximum loss? You could filter those out. What's the average return? Okay, not 9, 7, 7%. You can start around and say, oh, hang on, look, the Charles Schwab called BlackRock average return is 6.80%. Now that looks like interesting. Great, look at that. So you can see that these individual stocks reflecting some of the strength of the index. Yeah, that's exactly gas, oil, heating, weather. Just take a look at oil, WTI crude, for instance. You know, when you're getting to the driving season, right? You tend to see upside in WTI crude, and then when you come into the end of the year, you tend to see downside, right? The other things to point, so that's very good. The events are great, and you can filter with of course all these different events, turn of the month, turn of the quarter, US reports, non-US reports, the elections, UK, US midterms, central banks. You can look at the impact of Fed meetings, ECB meetings, very helpful. And intra-month, right? You can see how instruments tend to behave intra-month. That's very like so. Let's have a look at the S&P 500 intra-month. What do you see? Let's have a look. There you go. Look at the recent after the last 5 years. Okay, look. So here we are. We're 12th. Oh, tends to see. Oh, there's a bias for fools. Okay, it's about 50%, but anyway, quite noticeable. Okay, had a down day today in the E-mini. Yeah, okay. Bias towards mid-month, and then look, turn of the month tends to pick up as you head into the end of the month, right? Okay, Jeff, I think I could invite you back in here now for some Q&A. I hope that's given you a flavor of Seasonx and what's involved with it.
Giles, yeah, thank you. That's great. Super, super interesting. Also, just to see the speed of how quickly you can kind of pull something together is
Amazing, isn't it?
kind of stands out to me. A couple of things, if I could. I mean, one of the things you were just kind of covering there was um, the seasonals on sort of like the intra-month seasonals. Can we go down as far as like intraday as well?
On the Bloomberg app, you can for some instruments. As it currently stands, we can't go intraday.
Cool.
But I think, I'm not sure we have to speak. This is where you need Dimitri and not me.
No
I'm not sure
worries.
if that will be coming. But I know that he has the information on intraday, like the DAX, S&P 500, which is super interesting, but it's not available on the app.
Okay, understood. And I mean, I'm guessing it's like I saw that there's 25,000, sort of markets available. I'm guessing that there's different sort of look back periods available depending on what the market is. But are we looking like an average thing? I think you were showing roughly what, 20 years basically of sort of like look back data?
Yeah, so like gold go back 56 years, S&P 500 I
Okay.
think goes back like 96 years, right? So you
Wow.
go back nearly 100 years. If you take like Apple, 43 years. So the look back period is generally quite long. Obviously, if it's a new instrument like Bitcoin, you can see that only goes back 14 years.
Right.
Otherwise, in using the SeasonX app, it's a long look back. There's never a time really where I've ever thought, oh, hang on, this isn't much data. Dimi's done a fantastic job and it's very robust.
Excellent. Um, you kind of covered the range for those volatility events or just like events themselves, which was super interesting for me
Yeah.
because I trade sort of short term a lot of the time here as well.
Yeah.
When we were talking at the beginning there, you mentioned that you trade the E-minis yourself, and I think you said intraday. So
Yeah.
how do you tend to make use of Seasonax for intraday E-mini trading?
Oh, that'd be like, so say I've got the CPI tomorrow,
Yeah,
right? Now I'll have a quick look at the event. So I'll just call it up and I'll just have a look. Okay, what's going on? CPI tomorrow. There it is. Let me look at the S&P 500 and I can see straight away there's a slight bias for selling over the last 10. I probably might, I want to look a bit more recently, 5 years, and say, okay, look, when the E-mini gets hammered, I'll look at some of the max drop figures.
yeah,
Okay, -2, minus 0.5.8, 9.51. So, okay, they're sort of clearly outliers, but I can see 1.42, 1.9, 1.30. So then if I'll put that together with my macro picture, and I think, okay, if I get an out of consensus beat, what kind of move would I use? And then that just gives me great confidence in targets. It's going to allow me to hold intraday shorts with more conviction. And it's just going to give me a better sense of where my ultimate target will be. And that's how I use it. Just like that. Very quick and as quick as that.
yeah. So it kind of gives you it can give you a bit of a bias maybe going in, and then some directional or a directional bias, but then also a potential range bias as well. For example, like how far we
Yeah.
could get to on the day.
Like I just use it in a very specific way, but there's other ways that you could use it as well. So that's the beauty of it. And obviously you have your own sort of way of using Seasonax that you use.
I gotcha. Understood. Just looking at the Q&A, Robert's put a question in there asking about, I think you said it was a detrend button that you pressed. Could you explain a bit more about what's going on there?
Yeah, so with the detrending, if you just hover over the button, let me just show you. It has a little explanation. And basically what it does, it takes out some of the data. Like if you imagine the S&P 500, what's the trend of the S&P 500 over the last like 90 years? It's up, right?
It's always up,
It's
yeah.
always up. So you
Longer
might think,
term.
well, hang on, of course, of course there's a seasonal bias for gains. What are you talking about? And what the detrend button does is it takes out that overarching trend and shows you what the actual seasonal bias is, given the fact that there's this overarching trend as well. So it separates the two out. And so I always hit the detrend button because I want to get to what's the actual root trend here of the seasonality rather than what's just part of the fact that the S&P 500 has been going up for the last 90 years. And that's what the detrend button does. It differentiates those two.
Gotcha. That's quite useful for especially for specific markets like the S&P.
Yeah. Oh, yeah. Like really useful.
Um, one of the things that you were kind of going through before, and we're just talking about seasonals and cycles and that sort of thing, you mentioned, I think it was the gold with sort of how India and China
Yeah.
have certain buying patterns. But now some of those buying patterns may be linked to like a lunar year or like a lunar calendar rather than like a
Yeah.
Gregorian calendar. So is there any way to, because those dates move around, I guess, don't they? Like Diwali for like the Indian New Year. Well, it's roughly the same time, but it'll move a little bit here and there, and that might be enough to kind of throw things out of whack. Is there any way of handling for that?
Yeah, that's a really good point, Jeff. And I never thought about that. So I tend to see the period as like, quite large periods, sort of 6 week blocks.
Yeah,
So I guess when I'm looking at it, that sort of factoring in for that. But that's a great point, Jeff. If it's coming earlier in the year or later in the year, does that have an impact? And I'm not sure, but that's a really interesting question. But what you could do is you'd have to do that separately because I don't think there's a Gregorian calendar or a separate calendar feature.
yeah.
You'd have to do that independently. But that's a really interesting point.
Cool. So, with that in mind, is there any way of exporting out some of the data for analysis elsewhere? Like if you want to pull it into a spreadsheet or Python or something like that?
Yeah, that's a really good point as well. And you'd have to that's one where you need Dimmy for.
Okay, okay, no worries.
And I know he guards his data. I know.
Yeah.
So you might have to fight him at Pistols for Dawn for that one. But joking aside, that's a really good question, and one to ask the team. I don't know the answer to that, Jeff, I'm afraid.
No worries. Do you have an idea of your users? Are there certain markets that people tend to use more or use the software for more? And I guess what the first thing that kind of comes to mind for me would be like commodity futures, right? Because you've got that sort of annual sort of harvest cycle where they originally came from.
Yeah. Yeah. US markets, S&P 500, major indices, the major US stocks,
Yeah.
major commodities, and then major US events.
Okay.
That's the major drivers of financial markets. So that's the main interest.
Okay. And I think I saw in there when you were clicking around, but there is, I think, data in there for those, like, say, commodity futures and so things like wheat or
Oh
uh,
yeah.
the meats, like pork bellies, lean hogs, that sort of thing.
Oh yeah. There's so many here. You could just have a quick look here, and you could look at the commodities. Um, you got here cotton, soybeans, zinc, copper, lean hogs, crude, silver, wheat,
Okay,
sugar,
great.
natural gas.
Yeah, it's all there. And I'm guessing like for somebody who is maybe, like a technical analyst who's pretty seasoned in seasonality and cycles
Yeah.
and that sort of thing, who's pretty familiar with that sort of thing, or maybe has ideas for what they've witnessed or they've read something in some bit of research or somebody's book. I guess they could just come here to get a quick overview of how that's working or how maybe that's worked since maybe a report was published or something like that. It just seems like an easy way to get a handle on something that you may have seen, sort of elsewhere, right? I mean, or do you guys build in some of those obvious ones like sell in May, go away? Um, there's
Oh
another
yeah.
one around the Jewish New Year's, I think. Like I forget what it is exactly. It's
Yom
like
Kippur, is it Yom Kippur?
yeah, it was like by
Hanukkah.
Yom Kippur, sell Rosh Hashanah or something like that, right?
Yeah, yeah. Yeah, I mean, you'll look these up. They're not kind of flag. It's not like flag posters and there's a sell in May, go away
Okay.
button, but you see it so
You could
quickly.
you could dial it in.
Oh yeah, as soon as you just pull up the chart, you can see basically S&P 500. The first thing that strikes me is almost like, okay, yeah, from Halloween, buy from the start of Halloween,
Yeah.
just very strong S&P 500, really such a strong trend.
Well, what's really interesting to me is just kind of seeing the I guess the ease and how quickly you can actually dial in on some of these things. If you want to pull that data and do the analysis yourself, of course, there's a lot of tools that help with that these days, but
Yeah,
I think you'd struggle to do it so quickly, or at least to get like a really like a quick overview of, oh, okay, here, this is roughly what's going on here, which may be enough for you to use as a filter or a bias layered in
yeah.
with another sort of trading process.
Yeah, exactly. It's very easy to scan quickly, and you can get like a virtually instantaneous view of the data over 20, 30 years and see where the outliers are and what you can reasonably expect.
Gotcha. Jason's asking if there are other cryptos available. I think we saw Bitcoin earlier.
Yeah, so you got Litecoin, let's say you have Ethereum. Um,
Ethereum, yeah.
yeah, no, I'm not sure. I'm not a great crypto fan, so not fan. I'm not a great understander of crypto. So apart from Bitcoin and Litecoin, that's it. You've lost me now.
Okay, yeah, no worries. I mean, I think, we often, the work that I do on crypto is, we kind of treat Bitcoin as the S&P in a way, right? It's sort of like
Yeah, right.
the
Yeah,
market, and then the other ones will tend to be somewhat correlated. Of course, that's not always true. There's a lot of different crypto coins out there, but there's probably
yeah,
not enough history in many of them to be able to build up enough significance or
yeah.
statistical significance. So that's a good question itself. Is like, is there a sort of minimum level of statistical significance
Yeah.
that we go for? I mean, often I would say 30 data points, but that means going back sort of 30 years or 25 is what you were looking at for many of these.
Yeah, so basically about 10 or 15 years you want really to
Okay,
start building up a pattern. That's generally what we say, about 10, 15 years.
gotcha.
I'll be interested to hear what Dimitri said on that.
Okay,
But about 10 years is what I have as a rule of thumb.
gotcha. Um, Stephanie's asking about earnings. Do we see where earnings land in the calendar?
No, but what you see their effect.
Okay.
So what you're looking for is there a seasonal reaction to the earnings rather than the earnings date itself?
So does that mean that Season X knows what the earnings date was and is looking at it more from like an earnings plus or minus 1, 2, 3 days, something like that?
No, so it doesn't have an event like that,
Okay.
like earnings at the moment. Although Dimitri's always adding new things, but these are the different events. And what Season X does, it just, like with Microsoft, for instance, you're getting the third quarter earnings.
What was it, October, huh?
Yeah, end of October, early
Yeah.
November. So you can just see the impact of the earnings, but you don't get the earnings date.
Okay. Okay. Understood.
Yeah,
Question there from Vaz around the ags and USDA
yeah,
reports.
yeah, right. I mean, you're going to have a reaction, aren't you, around those USDA reports as they look at the weather reports, yield reports, etc., etc. So again, it'll be very similar to earnings. You'll see a reaction probably around those reports.
Okay.
And that can be interesting if like there's see what that's in, say there's like a bias for upside around those USDA reports, but you see a couple of years with it where it went against the trend, you might be able to look up and say, well, was there something, untoward in the USDA report that changed that? That's the sort of thing
Yeah.
to look at.
Very good. Well, I mean, this has been a fantastic overview. You've covered quite a bit, quite a few markets here
Yeah.
and different sort of seasonal or cycle ideas. So thanks so much for that. If anybody has any further questions, please drop them in now and we'll see if we can cover them off.
Yeah.
Otherwise, I'm aware that we've run over a little bit and I don't want to keep Giles for too much longer. He's put up that slide again where they're offering a 20% off coupon there. I think there's a trial available if you guys want to check that out. Um,
And that's definitely worth checking out the trial because you can, look at some fantastic seasonal patterns that you can just grab.
cool, cool, great. Well, Giles, thanks so much. I mean, this has been eye-opening, really. Really, really great to see. And I remember kind of going through this with Taya
Yeah.
a couple of years back, and I was fascinated by it then. And I just think it's a way to get a quick handle on some of those seasonals that you see and you hear about in so many places. A lot of members do talk about seasonals. Like Robin Griffiths is pretty big on seasonals, and I don't have it fully in my head as to how I could kind of layer in that sort of thing, like his approach. But I'm sure that you could actually look at that and then probably test it out with some tool like this. Um, so that's been great. Giles, thanks so much for stepping in for Dimitri. You've done a great job. You're
Thank
clearly
you very
familiar
much.
with
Yeah, I
the
had big
tool.
shoes to fill, and I'm afraid you didn't get Dimitri, but I hope you get him another time. He's definitely good value. So,
I'm sure we will. And he's already very excited about IFTA in London in 2026. He
oh, very
wanted us
good.
to get him signed up for that as fast as we could. So we've got him on the ride for that. So yeah, he's there. Um, Well, if you guys you've got the website there to be able to reach out and get in touch. I hope this was useful for everyone to check out how you can look at seasonals in a sort of quick way. For our members, just a little bit of housekeeping, Giles, as we kind of wrap it up here. We've got the December meeting is an in-person meeting. This is, of course, the webinar or Zoom-based one. December's in person in London. That's going to be the AGM, where we've got the usual sort of voting for full members. So would encourage everybody to come along for that. It's also kind of a bit of a Christmas party. We've got drinks and nibbles and that sort of thing available. Also, we are looking to see if we can get a special guest in. So not confirmed yet, but we may get a guest speaker on for that day as well. And if not, then we're going to have a great time and just have some drinks and some food and some networking there. So that's going to be a fun time, and look forward to seeing everybody there. Giles, again, thank you for jumping in here last minute. It's been great.
So
And thank you to everybody else for coming along and sticking with us.
yeah,
Great.
yeah.
I think
I think got Stephanie had a question that I'll just
oh,
quick.
I'm sorry.
No, she just said the most distinguishing features versus the competition. I would say it'd be four things. So one, Season X is very usable. It's quick to use. Secondly, huge range of instruments. Thirdly, the screener function is so quick to use and fast. And fourthly, it's just the fact that new events are being added all the time. So different type of like market events. So I'd say they're the distinguishing features.
Great. Thanks for picking up on that last one. I missed it. Uh,
Yeah, that's great.
Giles, again, thank you. Thank you again. I'm seeing some nice thank yous coming through on the chat. Thanks to everybody, and we look forward to seeing you at the next STA event. So have a great rest of your week, everybody, and hopefully we'll see you in December. Cheers, everyone.
Thank you, Jeff. Thank you, Katie. Good. Thank you
Thanks.
all. Good evening.